Something very strange just happened in the silver market, and if you're not paying attention, you're about to get blindsided by one of the biggest financial misdirections of the year. Over $5 billion worth of silver was just dumped onto the market in a coordinated move that sent prices tumbling, and mainstream media wants you to believe it's simply supply and demand at work. But here's what they're not telling you. The timing of this dump, the players involved, and the technical fingerprints left behind all point to something far more deliberate than a natural market correction. And when you connect the dots to what's happening right now with the dollar, treasury yields, and central bank gold buying, this silver sell-off starts to look less like economics and more like engineered panic. Welcome to the Wealth Continuum, where we break down the financial moves that Wall Street doesn't want you to understand. If this kind of deep analysis matters to you, go ahead and subscribe now, because what I'm about to walk you through is going to change how you see precious metals, currency wars, and the quiet battle happening behind the scenes in global finance. You won't hear this anywhere else. Let's start with what actually happened. On a seemingly ordinary trading day, silver futures markets were hit with massive sell orders totaling over $5 billion in notional value. This wasn't retail investors panicking. This wasn't even large funds rebalancing. The volume and speed of the orders were institutional, coordinated and timed perfectly to trigger stop losses and algorithmic selling programs. Within hours, silver dropped nearly 8%, and predictably, financial media rolled out headlines about weak industrial demand, a strong dollar, and fading inflation fears. The story they want you to accept is simple. Silver went down because people don't want it anymore. Case closed. Except nothing about this makes sense when you actually look at the fundamentals. Physical silver demand is at multi-year highs. The U.S. Mint reported record sales of silver eagles in recent months. Industrial consumption, particularly in solar panels and electronics, continues to climb. Meanwhile, above-ground silver inventories registered with exchanges have been falling steadily. So how does a metal with strong physical demand and shrinking available supply suddenly get hit with a $5 billion paper dump that crashes the price? The answer is that paper silver and physical silver are two completely different markets, and the paper market is where the manipulation happens. Here's how it works. Silver trades in two worlds. There's the physical world where actual bars and coins change hands, and then there's the futures market where contracts representing silver are bought and sold, often with no intention of ever taking delivery. The futures market is where price discovery happens, meaning the price you see quoted for silver is determined not by people buying real metal, but by traders exchanging paper contracts. And because futures markets allow massive leverage, a relatively small amount of capital can move prices dramatically. When someone wants to suppress the price of silver, they don't need to sell actual metal. They just need to flood the futures market with sell orders, and that's exactly what happened here. But why would anyone want to suppress silver? This is where it gets interesting. Silver isn't just an industrial metal or a store of value. It's a direct competitor to fiat currency, and more specifically, to the US dollar. When confidence in paper money falls, people historically move into tangible assets like gold and silver. Central banks know this. Governments know this. And the financial institutions that benefit from a debt-based system built on fiat currency absolutely know this. A rising silver price signals something the establishment doesn't want you to see, which is declining faith in the currency system itself. So when silver starts climbing too fast, especially during a period when treasury yields are spiking and the dollar is under pressure, there's a strong incentive to knock it back down. Now let's talk about timing, because timing is everything in markets. This $5 billion dump didn't happen randomly. It came right as the Federal Reserve is navigating one of the most precarious positions it has faced in decades. Inflation is not under control despite what official numbers suggest. Real inflation, the kind you feel at the grocery store and the gas pump, remains elevated. At the same time, the Fed is trying to manage a ballooning national debt that is now beyond $35 trillion and rising. Treasury auctions are becoming more difficult. Foreign buyers, particularly China and Japan, have been reducing their holdings of U.S. debt. The Fed itself has been shrinking its balance sheet, which means it's buying fewer treasuries. So who's left to buy all this debt? Domestic buyers, and whatever demand can be manufactured through financial engineering. Here's the connection. When silver and gold rise sharply, it sends a message to global markets that investors are losing confidence in bonds and fiat currency. That makes it harder for the U.S. government to sell debt, because why would you buy a treasury bond yielding 4 or 5%? When inflation is running hotter and precious metals are screaming that paper assets are losing value, a rising silver price is a flashing warning light that undermines the entire debt structure the U.S. economy is built on. So when silver starts to break out, there's enormous pressure to cap it, to create the illusion that everything is fine and that there's no reason to flee into hard assets. And this isn't speculation. There's documented history of precious metals price suppression. In the early 2000s, a group of traders were caught manipulating silver prices through spoofing, which is placing fake orders to move the market and then canceling them. Major banks paid hundreds of millions in fines. More recently, investigations have shown coordinated selling in gold and silver futures during low liquidity hours to maximize price impact. The playbook is known. Dump large sell orders when the market is thin, trigger algorithmic stops, create a cascading sell-off, then cover your shorts at lower prices and profit. Rinse and repeat. What makes this recent dump particularly suspicious is the lack of any corresponding news or fundamental shift. There was no major economic report, no geopolitical event, no change in industrial demand forecasts. Just a sudden massive wave of selling that appeared out of nowhere and evaporated just as quickly. That's not how organic markets behave. That is how controlled markets behave when someone with deep pockets and specific goals decides to move the price. Now, think about who benefits from this. Obviously, anyone holding short positions in silver futures profits directly when the price falls. But the larger benefit goes to the institutions and governments that need to maintain confidence in the fiat system. A falling silver price makes treasuries look more attractive by comparison. It reduces the appeal of alternative stores of value. It signals to the public that precious metals are risky and volatile, not safe havens. And it gives central banks more room to continue their monetary policies without facing immediate backlash from a market running into gold and silver. At the same time this silver dump was happening, something else was quietly unfolding. Central banks around the world have been buying gold at the fastest pace in over 50 years, not selling, buying. The People's Bank of China, the Reserve Bank of India, the central banks of Turkey, Poland, Singapore, they're all accumulating physical gold. Why? Because central bankers understand what everyday investors are only beginning to realize, which is that the current monetary system is unstable and that hard assets are the ultimate insurance policy. But here's the twist. While central banks buy gold, they allow silver to get hammered in the paper markets. Why? Because silver is the people's metal. It's affordable. It's accessible. If silver were to run alongside gold, it would signal a mass movement out of fiat and into tangible wealth. And that's a narrative central banks cannot afford. Let's also examine what's happening with the US dollar right now because it's directly tied to this. The dollar index, which measures the dollar against a basket of foreign currencies, has been under pressure despite the Fed's relatively hawkish stance. Normally, higher interest rates strengthen a currency, but the dollar's strength is increasingly artificial, propped up by the lack of alternatives rather than genuine demand. Countries are slowly diversifying away from dollar reserves. Trade agreements are being struck in local currencies. The BRICS nations are openly discussing alternatives to the dollar for international settlement. This isn't happening overnight, but the direction is clear. The dollar's dominance is eroding, and as that happens, the pressure on precious metals to rise intensifies. A strong silver price would confirm this erosion. It would validate the concerns of those who see the writing on the wall. So it makes perfect sense that as the dollar's structural problems become harder to hide, we'd see more aggressive interventions in the silver market to prevent it from becoming a visible symptom of dollar weakness. The $5 billion dump isn't just about making money on a trade, it's about controlling a narrative. Here's something most people don't realize. The silver market is tiny compared to other asset markets. The entire above-ground investment silver supply is worth maybe $50 billion. Compare that to the bond market, which is valued in the hundreds of trillions, or the stock market, which is in the tens of trillions. Silver is a rounding error, but precisely because it's so small, it's incredibly easy to manipulate with relatively modest amounts of capital. $5 billion is pocket change to a major central bank or a coalition of bullion banks acting in coordination. Moving the silver price is cheap, and the strategic value of keeping it suppressed far outweighs the cost. And let's not forget the role of perception. Markets are driven as much by psychology as by fundamentals. If you can convince the public that silver is in a bear market, that it's a bad investment, that the sell-off is real and justified, then fewer people buy physical metal. Demand softens. Premiums drop. The whole narrative becomes self-fulfilling. But if you look at what's actually happening on the ground, premiums on physical silver remain elevated. Dealers are struggling to keep inventory. Delivery times are extended. The disconnect between paper price and physical availability has never been wider, and that tells you everything you need to know about which market is real and which one is synthetic. So what does this mean for you? If you're holding physical silver, this dump is noise. It's a paper market distortion that has nothing to do with the long-term value of the metal you own. In fact, it's an opportunity. Every time the paper price gets smashed, it creates a chance to acquire more physical metal at a discount before the gap between paper and physical becomes untenable. And make no mistake, that gap will close. It always does. You can suppress a market temporarily, but you can't defy fundamentals forever. When the physical market finally overwhelms the paper charade, the snapback will be violent. If you're thinking about getting into silver, understand that this is not a trade. It's a position against systemic fragility. You're not buying silver because you think it's going to double next month. You're buying it because you recognize that the financial system is built on leverage, debt, and monetary expansion that cannot continue indefinitely. Silver, like gold, is a hedge against the consequences of that reality. The fact that powerful entities are willing to spend billions to suppress its price should tell you how important it is that you do not own it. We're also seeing increased rhetoric around central bank digital currencies, and this ties into the precious metals picture. CBDCs represent the final frontier of monetary control. They allow governments to track every transaction, impose negative interest rates, and even freeze accounts at will. In a world where your money is fully digital and fully controlled, hard assets become the only true form of financial sovereignty. Silver and gold can't be hacked, can't be inflated away with a keystroke, and can't be seized remotely. They're the antithesis of the controlled digital money system being built. So it's no coincidence that as CBDCs move closer to implementation, we see more aggressive suppression of the metals that represent an exit from that system. Think about what's been normalized over the last few years. Trillion-dollar deficits are routine. Money printing is policy. Inflation is dismissed as transitory, even when it clearly isn't. Savings accounts yield nothing in real terms. Bonds are a guaranteed loss after inflation. Stocks are trading at nosebleed valuations, driven more by liquidity than earnings. Real estate is unaffordable for an entire generation. Where exactly are people supposed to preserve wealth? The answer they don't want you to consider is tangible assets, and at the top of that list are gold and silver. This $5 billion silver dump is psychological warfare. It's designed to shake confidence, to make you question whether precious metals are worth holding, to steer you back into the system where your wealth can be monitored, taxed, inflated, and controlled. But the more desperate these interventions become, the more obvious it is that the legacy system is in trouble. Healthy markets don't require constant intervention. Healthy currencies don't need to suppress alternatives. The very existence of this level of manipulation is proof that something is deeply wrong. Now, I want you to think about this. What happens when the physical shortage becomes undeniable? What happens when industrial users can't source the silver they need because investment demand has drained available supply? What happens when a major exchange defaults on delivery because there's not enough metal to back the paper contracts? These aren't hypothetical scenarios. These are real risks that grow every time the paper price diverges further from physical reality. And when one of these events occurs, the repricing will be swift and brutal. People who waited for confirmation will be too late. People who dismissed the manipulation will be caught off guard. People who understood what was happening and positioned accordingly will be the ones who preserve and grow their wealth through the chaos. The end game here isn't complicated. Fiat currencies have a lifespan, and every single one in history has eventually failed. The dollar has lost over 90% of its purchasing power since the Federal Reserve was created. That trend is accelerating, not reversing. As the debt grows, as deficits widen, as monetary policy runs out of tools, the flight to real assets becomes inevitable. Gold and silver aren't speculative bets. They're the historical constant that reasserts itself every time a monetary experiment collapses. So, when you see a $5 billion dump in silver and the media tells you it's just the market working, ask yourself who benefits from that narrative. Ask yourself why physical demand remains strong while paper prices collapse. Ask yourself why central banks are hoarding gold while silver gets plummeted. Ask yourself whether the institutions that got us into this debt spiral are trustworthy guides for protecting your wealth. The silver sell-off is fake in the sense that it doesn't reflect true supply and demand. It reflects the paper games of entities that profit from maintaining the status quo. But the implications are real. The system is fragile. The interventions are becoming more obvious. And the time to position yourself outside the blast radius is shrinking. I want to hear your thoughts on this. Do you think the silver market is being manipulated, or do you believe this was just a normal correction? Have you noticed the disconnect between paper prices and physical availability? Drop your take in the comments because this conversation matters, and the more people who understand what's happening, the harder it becomes to gaslight an entire market. This is the wealth continuum, and if this kind of analysis resonates with you, make sure you're subscribed because the next few months are going to be pivotal, and you're going to want to stay ahead of the narrative. The wealth you protect today is the freedom you preserve tomorrow.